Welcome, everyone. Welcome to Mapping Your Path, Mutual Funds and ETFs for the Long Term. This is Sean Howell. I'm taking the third session here. We're going to continue down this pathway. Aaron and Rick kicked it off with just a great session, kind of getting you thinking about things like saving and credit scores and managing debt. And then Dave was talking about just the overall, why do you invest? What's the approach? Rule of 72, getting started earlier, dollar cost averaging, all that. This is the first session where we're going to talk about actually putting some of that money to work. So one thing I want to explain is that mutual funds and ETFs, although the vehicles are complex, kind of what the entity is a complex thing. Getting started with these things is simple. It's easy. So I've walked you through it. I think you'll see just kind of how simple it is, but there are things that you need to know, need to understand, and need to make decisions on. So I'll also be going back and forth. This is the first time that we're doing this in today's sessions at least, where I'll be going from PowerPoint, and then I will be switching over and sharing eTrade.com to illustrate some of the points, and then I'll be switching back. So heads up that you may need to go from the slides, like you're looking right now at the disclosures. You may need to go from the slides and switch to the media player. It should switch for you, but if you hear me saying something like, see right here, and you're not seeing there, switch over to the media player. And then as I go to wrap, a couple of quick reminders. Please look in the upper right-hand corner. We want you to just be able to click that, and that will launch the next session, which is going to be Rick in that case. But also the survey pops up. Let us know how this worked for you. Let us know what it is that you need, because we understand that you're on kind of a path. As I'm going through this, because I'm going from slides to an actual presentation, I'm going to have to use real symbols. I'm picking those symbols not because I'm thinking they're the best or you should put your money. I'm picking them because they illustrate my points. That's it. No recommendations, no advice. I just want you to understand how to utilize the tools, and that's what this disclosure is about, and that's what this other disclosure is about as well. So with that being said, I've got 43 minutes, and we'll see if there's time at the end to answer some questions, but let's go ahead and dive into the material. So here's my agenda. First of all, I want to explain what a mutual fund is and then talk about some of the things, the pros and cons of it. And then I'll compare and contrast that to an exchange-traded fund. Now, I really enjoyed Aaron's little sidebar with Rick talking about when he was an MBA student and he started with an E-Trade account, and it was a small money account, and that's sort of, as he was learning, he started to put some of his learnings and some of his money into the markets. Well, we all have to start somewhere, and I appreciated him saying that because I started somewhere too. Now, I started right out of college I'd gone overseas and I'd made some money. I was an English teacher in Japan, and I'd come back to the United States with some savings, and I wanted to put that money to work. While I was in Japan, my parents were sending me care packages, and in those care packages, I was asking them to include a couple of copies of Money Magazine that I had missed out on. So when I came back to the U.S., I knew about diversification, I knew about controlling debt, I knew about savings, I knew about dollar cost averaging because I'd been reading those. But I wanted to put those to work, and I didn't want to pick individual stocks, or I didn't want to use complex things like options because I didn't know anything about that. So I wanted kind of heavy lifting to be done by getting into mutual funds and ETFs, and that's where I started. If you ever attend any of my other sessions that I teach the more complex stuff. I teach the options, but I didn't get started with that. It was many, many years before I decided to go that route. You may never decide to go that route, and that's perfectly fine. There's nothing wrong with mutual funds and ETFs. So let's get into the pros and cons, as this may be the right place for you to start. So it's important that you understand what they are, so you can make that decision as well. Okay, so the basic characteristics of mutual funds is it's a basket of securities such as stocks or bonds. So Dave was just talking about kind of having that mix between stocks and bonds. If you're younger and more aggressive, you're going to want to have a heavy mix of stocks. As you get older, closer to retirement, you want to have something that is less growth-oriented and more stable, and that may be bonds. Instead of picking all these individual stocks and bonds to create that mix, you can pick a basket of those that are already sort of pre-mixed for you. Now, when you buy into a mutual fund, you are the investor, and you own a proportional share. So we're pooling together, or I should say, the fund is pooling together the assets, and then with those assets, they're going to be investing it into various instruments, and that's what we're saying here with the third bullet point. The investor funds are pooled, and they are professionally managed by people. They are making decisions on behalf of the investor. Now, this is going to be different than when we get into hey, Dave, let me just ask you real quick. Is my sound coming through okay? Do I need to switch in any way, or are we okay?
You sound okay to me.
Okay, great. Thank you. So everything is pooled together and invested, and then it's managed. A lot of times I hear from people just getting started, when do I know when do I know when to get in? When do I know when to get out? How do I decide on all these various stocks? What should I be looking at? Charts? Should I be looking at their balance sheet? What should I be looking at? Maybe don't worry about that, because when you get into a mutual fund, they are being managed by professionals. Now, those professional managers are getting compensated for managing it, and that is going to be part of the expenses associated with that, and I'm going to talk about it. Now, there are thousands of funds available at E-Trade, and I'm going to show you that in just a moment. Now, it's targeting all sorts of asset classes. So if someone comes to me and they say, I'm interested in getting into something like clean energy, how do I do that? Well, one of the ways you could do that is just getting into a mutual fund that invests in clean energy. Therefore, you don't have to become the expert in clean energy. The mutual fund management team will be the experts. They'll do the research, and they'll decide which ones to get in and in what proportions to get in. So that takes a lot of that stress off of the individual investor and handles a lot of the heavy lifting associated with it. So with every single investment vehicle, there are going to be things that you gain and things you give up. So let's talk about the investing pros and cons of mutual funds. Mutual funds have pros and cons. Here's a few to consider. Diversification. A single investment, let's just say $500, is going to be spread across a basket, and that basket could be stocks, bonds, or both. So it could be totally concentrated in stocks, and those stocks could have themes to them. They could be large companies, small companies, all companies. They could be international companies. They could be focused on things like green energy. They could be focused on things like banking and finance. You can really kind of choose the flavor that you want, or you could choose something that's very narrow or very broad as well. There is a professional management team that is going to determine the investment mix and the timing of trades based on that strategic theme. So as I mentioned, if you're looking for something like clean energy, you don't have to become the expert in that. The management team, that is what they focus on, and they decide how much of the pool of funds that you have bought into are they going to allocate towards company A versus company B, and hey, what about rising company C? Should we sell some of A and should we go to C, so on and so forth. So it's professionally managed, which means that you can focus on other things besides managing those individual funds. Now notice here that I say lower fees. Very often people think that they need to have a person, they need to have an individual financial advisor managing their money. Well, you can certainly do that, but you're going to pay a fee to that person. Whereas if you pool, since you've got these pooled assets that are being managed by professionals, it's usually a very large pool. So they don't need, in order to put food on their table, they don't need to necessarily collect as much in fees because of the size of the pool that they are managing. So therefore, there are generally lower fees with mutual funds than with going with an individual personal advisor that would give you bespoke guidance. So there's both a pro and a con here. One is you're pooling your money together, getting lower fees, but two, your situation may be different than the other people that are putting their funds into this particular mutual fund. So lower fees, and when I get to exchange-traded funds, I'm going to talk about the lowest fees when it comes to something like this diversified product. And here's another point. It's convenient. So choosing your own mix of funds can simply help to build a diversified portfolio. It's very simple, and I'm going to show you exactly what that looks like. So these are kind of considered, for me to be, hey, I want to get my money in the market. I don't want to have to learn all the things that you guys teach, but I also don't want to go out and get a financial advisor and pay he or she a higher rate to manage my money, but I want the diversification. I want the simplicity, and I want the convenience. Let's talk about some of the cons or the downside. Some mutual funds have high expense ratios. And what I mean by a high expense ratio, these are basically fees that you're going to be paying. Let's say that an average fund is 1%. If that fund was able to get you, let's say, 7% in a year, but that was the return, but 1% of that drops it to 6%. Well, Dave talked about the rule of 72. That 1% is going to change the amount of time that it takes for you to effectively double your money, grow your portfolio, hit your targets. So every single percentage point counts, and it's working against you. So yes, you've got people managing your money, but they do want to get paid. So the management fees, if you were looking at Fund A, which is 1%, and Fund B, which is, let's say, 0.75%, although those 25 basis points or the quarter percentage point doesn't seem like it's a lot, if you're going to own that fund or invest your money over 5, 10, 15, 20, 50 years, that 25 basis points adds up, and it's taking away from you getting to your goal. So it's important that you recognize the expense ratio and the fees. Some funds, in fact, will charge what they call a load. But really, a load is nothing but a commission. So do you need to get into a loaded fund? Not necessarily. There's a ton of no-load funds that also have some low fees, and I'll show you how to find those as well. Well, the performance of mutual funds, many passively managed funds fail to beat the benchmarks they measure themselves against. So if there's a large cap fund, a mutual fund that's going to invest in large companies, and that can be compared against a large cap index like the S&P 500, which is the 500 largest publicly traded companies in the U.S. market, don't be too surprised if the S&P does maybe 8% in a year, but your mutual fund does 7%. Wait a minute. If I would have just put my money in the S&P, I would have gotten 8, but here I only got 7. Why? Well, remember, that 1% maybe that you were paying to the management company is going to detract from your gains, or it's going to add to your losses. But at the same time, you're not the one that has to manage that. Now, ideally, what you're hoping to see is that by having it actively managed and diversified, that if the index, the S&P, does 8%, that the fund does 9%, including the fee. That would be great. That would mean that the active managers were getting you something higher than that, and we call that alpha, the ability to manage the money and improve upon what would have happened if it was not actively managed. There's uncontrollable tax events. See, because what's going on in a mutual fund, the managers are buying and selling things much like a more active investor would do in their own account. They are accumulating transactions, and those transactions, some of them they're making money, some of them are losing money. Ideally, they're making money. But at the year end, the mutual fund needs to pass through to the individual investors some of those gains. Year-end capital gains and dividend distributions can surprise you at the end of the year because you're going to pay taxes on those. And it's not something that you're going to know until you get to the end of the year. Whereas if you were managing your own stock portfolio, well, you'll know that you bought a share at $100 and you sold it at $110, and therefore you have $10 of gains. You'll know if a company that you bought for $100 paid you $1 in a dividend each quarter for a total of $4. So you'll know that because it's right under your nose. So uncontrollable tax events are something else to be aware of. The other thing, and again, I'm not going to say this is necessarily a good thing or a bad thing because I do trade. But when I first started, I didn't trade at all. I invested. I put my money in. I let the market do what it does, and I had mutual fund managers deal with it. There's no intraday trading. You buy and sell mutual funds after the close of the market at something called the NAV, which is the net asset value. And that's the number. So let's say at noon you decide, I think I'm going to put $500 into mutual fund A, B, C, D, E. Well, you put it in, and then you don't know what price you pay till the end of the day because all the different entities, all the stocks and bonds that make that up will get calculated up, and that will give you the net asset value. So when you buy a mutual fund, you buy in dollars, and that then gives you shares. And then maybe you say, hey, my kid's college tuition is kind of coming up. I need to liquidate $500 worth of mutual funds. Then you need to kind of figure out the number of shares that you would need to liquidate. And then you would say, hey, sell 20 shares of the mutual fund because I need to raise about $500 to pay towards my kid's college tuition. When you sell that, then at the end of the day, the net asset value will be calculated, and maybe it comes out to be 505 or 495 or something like that. So a little bit different when it comes to mutual funds. We buy in dollars and we sell in shares. Okay, let's switch over to eTrade.com and let's take a look at some of the mutual fund resources and exactly how we would approach them. Okay, I have already logged in to my demonstration account, and I will zoom in so you can see some of the things. So I've logged into my demo account. It's a live demo account. It's got a little bit of money in it here, and I think one share of a small stock that I went ahead and picked up this week as a demonstration as well. So where I'm going is across the top you have accounts, trading, markets, and ideas. And I'll zoom in so hopefully you can see. And if Dave or Rick, if there's any issues at all, please let me know since I can't keep my eye on the chat in the Q&A. So I'm at markets and ideas. And you can see we have, okay, great, thank you. I'm dropping down to mutual funds, and then next I'll go to ETFs. Now, where I live and breathe is this option section. This is what I do in stocks, but that's not where I started. I started here with mutual funds and ETFs, and it was an easy, comfortable place to be in, a great way, I think, to get started. I'm clicking on mutual funds, and I'm going to kind of go through a process here of showing you some things. Don't feel overwhelmed as I start, because I'm going to conclude with pre-built portfolios and showing you just how simple this can be. So first of all, let's start with the fact that we have thousands of mutual funds to select from. That right in and of itself is daunting. How do I pick which one I want? Well, we try to narrow this down for you by creating things like the All-Star list. And the All-Star list is going to contain mutual funds that we consider. We've gone through and we've pre-screened them, and you can download it here. There's 179 down from 6,000 and something. But we have screened these, and they have lower expense ratios in their performance. And let me just compare a couple for you here. And you can download it right there. You can see when this was uploaded. Now, across the top, we have things like domestic large. This would be U.S. large companies. Then we've got domestic mid and small caps. So not the big giant companies, but the smaller companies and the littler ones, international, fixed income, balanced sector, alternative, and other. So I can go through, and let's say that just getting started, if I just wanted to get my money to work and I wanted to do that in something like a large company, well, let's slice and dice it a little bit further. Are we looking at a large blend? So, well, let me compare and contrast this. Or are we looking for large growth? Growth is going to be something where a company is doing what they're doing, and they're taking whatever money they're making and generally rolling it back in instead of sharing in their profits with the individual owners, i.e. the people that own the stock, i.e. you, if your mutual fund has bought into that. So we've got growth, which is where it's all getting tied back in again. And then we've got things like value. And again, you can see things like a dividend growth. Well, this would be a mutual fund that is investing in companies that have both growth and dividends and paying them out. Now, a couple things across the top. NTF stands for no transaction fee, right? We're trying to keep our expenses as low as possible. If I go over to the right, we'll see something called an expense ratio. Think of this as fees. So remember, how are we paying the mutual fund managers? Well, we're paying them in our expense ratios. So if I take a look down here, I can see this one is 0.59 as the lowest and 0.85 is the highest. Okay, there is a difference between those two. So let's see how that would sort of look as far as performance. Well, if I look at the one-year return, you can see everything's in red. We all know the market is down, so that shouldn't be a surprise. But you want to be able to compare and contrast things like the 3-year return versus the 10-year return. All of these are how well does this fund perform. Now, let's say that I was attracted to the one that had the lowest fee, even though it may not have the highest 10-year return. Let's just click on it and get a little bit closer. And here's a little tip for you. When you see a mutual fund symbol, it's usually 5 long, and it usually ends with an X. So if someone says to you, hey, I just bought this great stock thing, and the symbol is CXXAX. When you hear that 5 symbols and you hear an X on the end, be thinking, oh, sounds like you got a mutual fund, and that's exactly what somebody got. So I clicked on it, and now I'm going to take a real quick look. And again, I just picked this one randomly here. And you'll see across the top, we've got a price. Now, that's the net asset value. And you can see that that net asset value would be as of the close yesterday, because we don't know how this fund is currently doing today, and we won't know till later on. I've got my snapshot. We've got things like public offering price. That's the price that it was previously. We can see the expense ratios. We can see their distribution yield. We can see that it's open. And then over here on the right-hand side, sales charge. Remember we talked about loads, front-end load. It's waived at E-Trade. Great. When do I need to make a decision if I'm buying or selling? I need to have that decision in by 4 p.m. Eastern, which happens to be the market close. And then let me go just a little bit deeper in. What if I just want to get a glance, like what kind of stocks are in this thing? Well, I went ahead and clicked on portfolio, and then let me scroll on down, and this will give you an idea. What is this thing investing in? Well, 99% of it is going into stocks. Okay, remember Dave was saying there's that mix of stocks versus bonds? This is all stocks. There's no bonds. Are you younger? Are you more aggressive? How much time do you have? How is this going to be in your mix? And just to get a flavor of some of the companies that are in it, look, it's a large cap fund. It shouldn't surprise you that you know all these names: Apple, Microsoft, Alphabet, Google, whatever they call themselves, Amazon, Tesla, NVIDIA, JP Morgan, Visa, Procter & Gamble, Home Depot, so on and so forth. Now, with active management, this could change. So the manager may say, yeah, you know, Microsoft's earnings just came out yesterday, and maybe I'm going to switch. I'm going to sell some of the Apple to buy more Microsoft, or maybe I'm going to sell some of this to buy some of that. They're making those decisions for you. You're generally along for the ride. So let me go back here real quick. So with mutual funds, again, there's a ton of choices, but let me dive in just a little bit deeper on it, and I'm going to go into the mutual fund screener. Now, I just came back from a trip to Cambodia and Vietnam, and I just saw, you know, the amazing growth opportunities in Phnom Penh, in Ho Chi Minh City, in Hanoi. So maybe I'm thinking, you know, I wouldn't mind getting involved in I wouldn't mind putting some money towards Asia, but I don't know enough about where to put my money. So I can go through and say, let's see what kind of mutual funds maybe I've got access to. I'm going to clear them all, 6,662. And maybe I say, well, I want an all-star fund. I don't want to pay any loads. And I'm going to drop down and just say fund name. Let's see if I can find something that has Asia in it, right? Well, there, I found one right there. I found the Morgan Stanley Institutional Asia Opportunity, MSAUX. It's an all-star list, right? Well, I screen for that. And I can get involved with this no transaction fee. Great. If I wanted to buy, I would simply hit buy, and that's going to load up my window. And remember, we talked about this with mutual funds. You buy in dollars, whereas with exchange-traded funds and stocks, you buy in shares. But when you sell mutual funds, you'll sell in shares, and I could go and preview the order and move forward. Okay, that's a little bit of the deeper dive, but I'm going to go and show you something that I think is maybe what would be a nice starting point. So we've got the All-Star, we've got the screener. We could compare mutual funds side by side. We could go into specific categories and look for top performers. I could do that with screener as well, but I like pre-built portfolios for the sake of simplicity. So let me show you what I like about this, and it really feeds into what Dave and Aaron were talking about. Our analysts selected leading mutual funds with no commission fees and created 4 diversified portfolios that may fit your investing goals. Do you remember Dave was showing you the mix between, I believe it was 75% stocks and 25% bonds, and how that performed? If you like that kind of moderate mix, then let me just show you how we could take something like the aggressive or the moderate. I am choosing the moderate in this case, and it explains a little bit about what kind of stocks might these mutual funds be investing in, talks about the portfolio risk, the time frame, the income potential versus something like conservative, where we've got lower portfolio risk, shorter time frame, with income potential being medium and higher. So again, this kind of allows you to scratch your itch without getting very complex. So if I go ahead and say see details, and I'm interested, someone asked me what would be a good dollar amount for me to start. Well, I had said 500 for great reason. That is the minimum to do this. So let me say 500. And my investment account, I only have my one demo account that I'm showing here. And I could set up a reoccurring purchase if I wanted, right? So I could have more money going in for a minimum of 25, and I could have it coming from this account that I've been talking about. And I could have that every week, twice a month, every year. So I can set up a disciplined plan. And then I'm not going to do the reoccurring, so I can explain this. Now check this out. Here's a sample portfolio. You can customize it by selecting. So I can customize this, but here's the one that was selected for me. It would be, my target allocation is 70%, so $350 of the 500, and 34% would go into Parnassus Core Equity. 12% would go into small and mid cap. 24% would go into international. 30% would go into bonds, and it would be this one right here. Now, if I hit place order, boom, that's it. That will take 500 out of the account, and it will put it into this distribution, and look at what I've got. It's done for me at that point in time. And if I choose to liquidate it, then I can go in and liquidate those. So very simple, even though the vehicles behind them are not. And if you wanted to dive a little bit deeper into, well, I don't know enough about this large cap fund, I want to do my research, great, not a problem. Here's where you can pop in and you can take a look at all of the parameters that we talked about. We can look at charts. You could dive as deep as you want, including if you wanted, you could go in and read the actual prospectus from the company. And, you know, here's some examples of the stocks that are in it. Again, things that you probably know, the performance, and similar funds if you wanted to compare. Okay, So hopefully that gets you where you need to be with the mutual funds. Let's switch back now. I'm going to head back over to my presentation. And now let's get into the exchange-traded funds. All right, the basic characteristics of an ETF, I'll do the same thing I did with the mutual funds. One is not better than the other. They are different. Now, my path was kind of as I'm presenting here. I started with mutual funds, but because I was in the industry, so I was learning more about stock trading and timing and utilizing charts. So my path went from mutual funds to ETFs to individual stocks to bonds, and that most certainly may not be the path that you take. Most of my friends generally focus on mutual funds, ETFs, and stocks, and they don't get into more complex stuff because they don't live and breathe this stuff like I've been doing for half of my life. You could go down that path, and we'll be there to help educate you. So let's talk about the basic characteristics of them. It's a basket of investments, so there's really no difference between a mutual fund and exchange-traded fund. It's a basket that we're buying into. And in an exchange-traded fund, it could have stocks and bonds, but also there are exchange-traded funds that have currencies. You've probably heard how strong the dollar is right now and how weak the yen and the euro and the pound sterling are. Well, if you think that maybe one of those, maybe the euro is going to have a really strong comeback and it's going to rally 10 or 15%, you can buy an exchange-traded fund that invests in euros. And so if your prediction is right and the euro rallies up, then your position will rally up too. But it can also have things like commodities. It can have things like gold or oil. It can actually have crude oil in it, but it's actually futures of crude oil. But you can do more things. So if someone says, is there an exchange-traded fund that does? My answer is generally yes, because there's thousands of them, just like with mutual funds. Is there a mutual fund that does? Yes, more than likely. We just need to find it, and that's why we have the mutual fund and ETF screener to find it. Same thing with the funds being pooled. Now, there's a portfolio manager, but that portfolio manager is just managing the money going in and out. There is not a person making decisions. So I want to be really clear on that. The mutual fund, there are people that are getting paid to analyze and make decisions about, do we put more in now? Do we take some out? Do we move it from A to B? The exchange-traded fund is a fixed basket. If that fixed basket has 20% of XYZ shares today, well, it's still going to have 20% of XYZ shares tomorrow. There's nobody going in and out. You are the only one making the decisions to either keep the ETF, buy the ETF, or sell the ETF. So it's like a stock, except that you are managing this basket. So the ETF shares trade on the market like a stock. So you'll buy 100 shares, you'll sell 100 shares. You'll buy one share, you'll sell one share, unlike a mutual fund where you're buying in dollars and you're selling in shares. Most exchange-traded funds are based on an index with many variations on theme. So if someone were to say, well, I want to invest in this NASDAQ 100 index that's been doing well, but how do I invest in the NASDAQ 100 index considering there's 100 companies in that NASDAQ 100 index? Well, you could buy all the individual companies, but that's very complex, very time-consuming. Well, I guess you could buy a mutual fund, but why would you buy a mutual fund that's being managed if you just want the index? Well, there's an ETF out there. Here's just one example, QQQ, which invests your money, pools it together, and buys all 100 companies in the NASDAQ 100 index in the same proportions as the index itself. So that's trades like a stock. It's quoted like a stock. It can be charted like a stock. So let's talk about the pros and cons between of an exchange-traded fund, not really comparing it to mutual funds. Just say that it's similar but different. Well, it's diversified, so that single investment in a basket of stocks, bonds, or both. So if you were to take, let's say, buy one share of QQQ, again, I'm just using that as an example. If someone says, well, how many stocks is that in? Well, because the QQQ is based on the NASDAQ 100 index, it's got 100 stocks in it. Well, can you name me some? Sure. Apple, Tesla, right? I mean, it's Intel. It's whatever that index is. If you were to buy one share of the S&P, of one of the S&P 500 exchange-traded funds, for example, SPY, well, that one share is actually spread out amongst 500 companies. Well, what are the 500 companies? Well, they're the 500 biggest companies that make up that index. So one share can get you diversification. You can even buy an ETF that has 5,000 different companies into it. So whatever that index does, you're going to do as well. So because you are holding a larger number of stocks in an exchange-traded fund, you are reducing single stock risk. But recognize something like QQQ is going to have whatever the largest holding of the NASDAQ 100 index is, which I believe it's probably still Apple. So you have the most exposure to Apple, but that's because the index has the most exposure to Apple, not because some fund manager decided to expose you to Apple. Low risk fees. So again, if we're talking about trying to seek diversification, you've got someone that could manage your money, a bespoke fund manager, I should say a bespoke advisor. That's going to be higher, but they're customizing it for you. Mutual funds that you select are going to have lower fees. And then when you're buying into exchange-traded funds, they really have the lowest fees because they're generally not being managed. Now, some are. There are a growing number of exchange-traded funds that kind of blur the lines in that there are people managing the assets, but at this point in time, they're kind of few and far between. My next point, they're tactical. ETFs are designed to trade like a stock and can be bought or sold in real time, making them both a trading and investment vehicle. My college-age son is trading in and out of exchange-traded funds, sometimes on a daily basis, so he's using them as a trading vehicle. If he thinks that the market is going to have an up day, he may go and buy shares of an index ETF, and then if he's wrong, he may quickly sell it because he's losing money. But if he's making money, he may stay in or he may capture his profits, but he can trade in and out of those. And another thing about some of the exchange-traded funds, and you'll see them if they have a moon when I switch over to eTrade.com, they can be traded 24 hours. So at 9 o'clock at night here in California, if I decide I want to get into some of the ETFs, not all of them, still few and far between, I can actually get into an exchange-traded fund at 9 p.m. So some of them do have round-the-clock trading, if you will. So let's talk about some of the downsides. Well, ETFs, not all of them have low fees. Some of these specialty funds have fees that are getting up to 1%. But most of them are very low, like a 0.2%. One of them out there that's an index fund is 0.09. That's what, 90 cents on every $1,000? So fees are important, but ETFs tend to have lower fees than mutual funds. Limited diversification. Some ETFs are heavily concentrated in a specific sector or may hold a small number of stocks. Let's say you found an ETF that was into electric cars. And so you bought the ETF thinking that you were going to be heavily diversified, and then you looked at the holdings and you found that, 66% of it was one company like Tesla, and then it was the smaller companies that are just doing EVs like Rivian. Well, have you really gotten diversified when 66% is just in one stock? Well, you're diversified, but not very well, simply because that ETF, there's just not enough players. So it's important to go and take a look at what the holdings are. Now, another thing, you are really just along for the ride. Since most ETFs track that fixed index, that investment will fluctuate with the underlying asset. So you can't say, as the market's going down and you're in an S&P 500 ETF, man, we're down 15%. why don't these managers go to cash, go to cash, go to cash? Well, no, you're on for the ride. Whatever the index is doing, you're going to go with it. Whereas if it's a mutual fund, generally the mutual fund will not go to cash, but they may move away from something they feel is it has more downside, and they may move to something they feel is going to be a safer place for you to go. So they're actively managing the funds. Now, some of these mutual funds, I mean, we're talking billions of dollars. So you can't just flip in and out of a stock when you've got billions of dollars. You have to be very strategic in how you're going to move that money because it takes time. Now, there's also some ETFs out there that are very complex. So some ETFs invest in complex financial instruments, not always suitable for new or experienced investors. Just because they're simple to get into doesn't necessarily mean that what is going on behind the scenes is something that you would be comfortable with. So I do think it's important that you understand a little bit about the exchange-traded fund. Now let me switch over again to eTrade.com, and let's just take a quick look at some of the ETF tools that we have, and I will pick up where I left off. So I left off on the pre-built mutual funds, and now I'm going back up. Let me zoom for you. I'm going back up to markets and ideas, and I'm going to ETFs. And ETFs, it's just going to look really similar. It's kind of the same layout. We have a general overview. We've got the all-star list. Let me zoom in again. We have an exchange-traded fund screener. And then let me quickly focus in on this. Do you remember I had just mentioned that little moon right there, and I had mentioned QQQ? Because what I did on the screener is I've clicked the extended hours overnight trading, and I can turn that off as well. If I just want to look at all stars, and maybe I want to drop down here, and again, I'll go with my theme. I was going to say let's go with Asia, but I'm going to change my theme to solar. Let's see, are there any solar funds that are on the all-star list? No, there's not. Let me turn that off. Now I'm out of the all-star. Well, it looks like there are two exchange-traded funds that are that have the name solar in them, and I can overlay my my cursor, and it's going to pop up the window. And here's another one called TAN. Oh, that's a cute name. Well, let's just click on that so I can quickly get a look, a snapshot as to what this thing is. Snapshot. Charts and quotes. Well, I can see it's having a pretty good day today. It's at up 4.77%. Wow, that's a pretty big move. What is my expense ratio? Well, remember I said some of them approach 1%. Some are as low as 0.09. This one's 0.66. So it's not quite as expensive as mutual funds, but it's also not cheap like an index one, right? Let's drop down here and see what kind of holdings this thing has. Well, if we take a look, 55% are in these 10 companies: In-Phase Energy, First Solar, Solar Edge, numbered, that's interesting, these are Chinese, Sunrun, so on and so forth. So I can get an idea, and as we get talking about stocks, you may say, you know, I'm just going to focus in on stocks instead of ETFs. But others of you may say, I just like the idea of getting diversified. Do you remember I just shown you the QQQ? Just for fun, let's pull up QQQ, and let's look at the same thing here. Expense ratio, 0.20. Well, what are some of the core holdings? Apple, Microsoft, Amazon, Tesla, Google. So if you want to get into these companies and you're interested, if you've got $280, well, we can get you one share of that, not a problem. Let me go back to markets and ideas, back to ETFs, and so there's a screener out there. I showed you that, but let's look at the pre-built ETF portfolio, and you'll see it's almost exactly like what I was showing you before when it came to mutual funds. So we've got aggressive, 90% stocks, 10% cash, all the way down to conservative, 30% stocks, 60% bonds, 10% cash. And again, this will explain simple, affordable, and flexible. Let's get started, and let's go with the same moderate setup that we were talking about before on mutual funds. What's included? Apple, Microsoft. Okay, Portfolio risk, medium, investing time frame, 5+, but again, these are liquid. You can sell them if you want any time. Income potential lower. Well, let's look at the details of it. And here's the mix that the pre-built screeners are talking about. And the mix is 70% stocks, wisdom tree, symbol DTD. We've got a small cap, 12%, international, 24%. And if I'm curious, hey, what is in this international developed and emerging market fund, I can click on the symbol, and it's going to take me back over to the snapshot. And from there, I can look at things like the net expense ratio, 0.07. Yeah, that's very low. And dropping down, I can look at what's in this thing. Well, I can see there's things like Taiwan Semi and Nestle. And so it's showing me, and these are all going to be overseas, 9.18% assets in the top holdings, meaning that this thing has a lot of diversification. Remember I said that we want to be careful of that concentration in just some of the major companies. These are very small percentages, so really spread out very, very broadly. Now, if I just wanted to buy this, remember we talked about how we buy and sell mutual funds versus ETFs. If I just want to buy a share of this, action, buy, how many shares? 1. Select the type. Get me in at the market price, and I can go ahead and say preview my order and buy my 1 share, and I can place the order and get into it. In fact, I know I'm right at my time. I may as well just go ahead and get in. Again, it's not a recommendation. I just want to show you how simple it is. And we'll get that order in. And let me go ahead and take a look at the order. And we can see that it has executed at 53.43. And then I can pop over to my portfolio. And I'm invested. It is simple as this. So I have basically 2 positions. One is a stock, and one is an exchange-traded fund. And I could sell this, but there is, and I know this question popped up earlier, there is something about selling too often the exact same day. But tomorrow, because this is my demo account, I'll come in and I'll probably just sell this and make a penny, lose a penny, whatever. I'll just go ahead and close it out. But I wanted to show you just how easy it is to go ahead and enter an order and to execute that order and get started. Dave, I'm 1 minute over, so let me quickly go to the final comparison here between mutual funds and ETFs. And again, you can download these, but take a look. We'll start with the left. You can buy and sell directly with the fund company with a mutual fund. Whereas with an exchange-traded fund, you are buying and selling on an exchange. So it transacts more like a stock. Second bullet point for mutual funds, it's priced at the net asset value after the market closes. So you're selling a little bit in the dark and you're buying a little bit in the dark. Whereas with an exchange-traded fund, you saw me do it. Boom, I'm in. Boom, I'm out. I used a market order. You could use a limit order. You could use a stop order. You could use a trailing stop. You can use some of the more advanced order types that generally people associate with stocks. The third bullet point for mutual funds, they're actively managed for long-term returns. There's people making decisions behind the scenes. Whereas with ETFs, they're basically, like I said, you're along for the ride. If the stocks within that ETF do well, then you did well. If they do bad, you do bad. It's not, wow, my managers really did a bad job of managing it. You are the manager. Many traditional mutual funds are index funds. So you can find mutual funds that are index funds, but you may find the equivalent with exchange-traded funds, and you might want to compare those to think about the fees, keeping your fees low. There's a very wide range of index ETFs available. There's inverse ETFs. There's leveraged ETFs, things that aren't really appropriate now, but ETFs have been expanding for the different appetites of investors and traders alike. And then finally, mutual funds are really for long-term investing. They're not short-term trading. Silly question I get is, can I day trade mutual funds? Why would you? I see zero advantage there. But with an ETF, they appeal to both long-term traders and short-term traders and everything in between because of what they do. So with that, my wrap, and we'll see if there's any questions out there that should be answered. Mutual funds and ETFs are the foundation for a long-term investment portfolio. They offer convenient, lower cost diversification as well as the potential for strategic concentrated investments. So if you want to start getting a theme around your portfolio, maybe your theme is going to be something like software and pharmaceuticals. Great, you can skew your portfolio to something like that. Maybe you want to skew your portfolio to something like international. You can do all of that by customizing the mutual funds and ETFs where you put more money or you dollar cost average into those based on risk appetite, age, so on and so forth. Dave, Rick, tell me where we're at, and if I need to go to wrap, then we'll do it.
Well, Sean, we had a very lively Q&A session going. I can promise you that. Tons of folks out there. But interestingly, I think your last slide there addressed many of the questions, and we were keeping up with them too. So given the time that we've got coming up at 2 o'clock Eastern time, I think we should let our audience get a chance to stretch their legs and come back and get registered in time for our next session. Why don't you close it out?
Awesome, great. So up in the right-hand corner, you can click that. That will launch you onto the very next session. So we'll see you there in a few minutes. But also, give us 2 or 3 minutes of your time, please. Type some notes, even if it's hey Sean, this could be better. Tell me how, or this was really useful, or tell us what you need over the horizon as you continue down this path. Thanks, Steve. Thanks, Dave. Thanks, Rick, for being in the background. For everybody for the Q&A, and I'll be in Q&A for Rick's session. So. Take care. We'll see you in just a few minutes. Bye-bye.